right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris Cormack. It is an honor to be here with you guys. If this is your first time tuning in, I am a CPA, certified tax planner, founder of Better Books, and it is our goal to eliminate the frustration and the bills that you feel when you are dealing with the IRS. We are working with mostly real estate investors, but also business owners who are looking to use real estate or other advanced tax strategies to pay Uncle Sam a lower amount. If that's you or anyone you know, we'd love to get in touch. We'd love to see if it's a good fit. And if not, we can point you in the right direction. But today, we're going to be talking about 4 mistakes to avoid when doing your own bookkeeping. I understand that a lot of business owners are doing their own bookkeeping. I don't advise it because I think that the costs of getting things wrong greatly outweigh the savings that you might have by not paying somebody a fee for doing bookkeeping for you. But I do want to make sure that if you are doing your own bookkeeping, you are taken care of, because again, if the costs are outweighing the benefits, that is a bad move. It is not an economical or a wise financial move in any way. So if that's the case, if that's how you feel right now, like the cost, the time, the money, the energy, the emotions that you feel around bookkeeping are outweighing the benefit that you're getting in the form of, maybe it's not a clean profit and loss, maybe your books aren't cleaned up, but maybe you're saving a couple $100 every month because you're not paying a bookkeeper, then if that's the case, I would strongly encourage you to consider hiring a bookkeeper, whether that's us or someone else. But today we're going to be talking about the 4 mistakes you should avoid when doing your own bookkeeping, because I understand some people, especially those getting started, are doing their own bookkeeping. Maybe you like it, maybe you're accounting minded and it's not that big of an issue. That's great, but you can still make mistakes, and we're here to help you avoid some of those mistakes. So the first thing to avoid is bad setup. You want to get started right, or don't start at all, right? If you're not started properly, it's going to cause a lot of problems down the road. I think of the running world, right? If you are it's pretty obvious when you're in the 100-meter dash. If you're in the 100-meter dash and you don't get off to a good start, you can kiss that race goodbye. You basically have to start well and end well, but the start is a huge part of it. Same thing with horse racing. The horses that don't start well usually don't end finishing in the top 3 or whatever it is. And the same thing goes with the bookkeeping in your business. If you don't get it started properly, if you don't have a strong foundation, your bookkeeping will crumble. And so for you, the listener, the viewer, if you are doing your own books, it's so important for you to get started well. If you're not confident, if you lack the confidence that you need to know that you are getting started off on the right foot, well, then you can hire somebody to at least set it up properly. Get the chart of accounts, get the bank account set up. If you're in QuickBooks, get the rules set up so that you have some sort of system that you can rely on, some sort of foundation that you can rely on, right? Jesus talks about this. He talks about the house that's built on sand versus the house that's built on a firm foundation. And the house that's built on sand crumbles. If your bookkeeping is not built on a firm foundation, meaning the chart of accounts is set up properly, you have the right categories, your bank accounts are running properly, then it's going to crumble, as opposed to the house that's built on a firm foundation, which in the Gospels is Jesus and his word, but in the form of bookkeeping, it is a proper setup. It's getting the account set up properly. It's getting your bank accounts, making sure that they're flowing in and out, that they're talking to another, right? We see a lot of people get it messed up in the form that they transfer wrong, right? They have one account they're depositing from into another account and they categorize it improperly. Maybe they categorize it as income unknowingly, and now you're paying taxes on that money that was just going from one bank account to another. It's not what you want to do, and it is something that you should strongly consider hiring out, just getting somebody to set it up properly so that you can have that confidence and that certainty, and you can have that peace of mind and eliminate the fear of messing up or the fear of the IRS audits that come because you don't get it set up on the right foot. So number 1 is a bad setup. You want to get set up properly. You want to get it done correctly. And I would recommend, if you're not going all in on getting a bookkeeper, I would recommend considering hiring them to get it set up properly, and then having them tell you, okay, these are a couple things that I would recommend you do as you continue to take this over yourself. All right, so that's number 1. Number 2 is bank reconciliation. I can't tell you how many people we review their bookkeeping and they haven't reconciled their bank accounts in 3, 4, 5 years. That is costly, because usually if there are problems, they come up in the bank reconciliation. We've had this happen. We have had our bank accounts not get set up properly. I remember my wife had a business credit card and it wasn't set up. It was on the same account as my business credit card, but for some reason QuickBooks wasn't registering it. So none of her transactions were coming into QuickBooks. And so we went through and reconciled our accounts and we saw, wait, there's 5 transactions that aren't accounted for in QuickBooks, but they came out and we paid for them. And so that only came as a result of the reconciliation. And then the bank accounts were off, right? So there was probably like a $500, $1,000 difference between bank balance and QuickBooks. And so it showed us that something was up. But if it weren't for the reconciliation, we would have no idea what was going on there. And those also are tax write-offs, right? So we would be paying for, say, supplies that Jasmine paid for on the business credit card, but we wouldn't get that on our QuickBooks. And now we have a larger income number and we're not getting the write-offs that we are qualified for. So there's a few things that come from that, right? You're not getting all the write-offs, your banks aren't in balance, and it's just leading to disorganization in your accounting, which is never good. It leads to chaos in your mind, but it also opens the door for IRS audits or overpayments on taxes, and that's what you want to avoid at all costs. So number 1 is bad setup. Number 2 is avoiding bank reconciliations. Don't do that. You want to be reconciling your banks. If you need help and you don't understand how to reconcile your banks, then reach out to a CPA, reach out to somebody who does know how, and you will be taken care of. Okay, so we have bad setup and we have bank reconciliation. Number 3 is tax-free income being miscategorized. I think I touched upon this a little bit in the bad setup portion, but again, there's probably been 5 times in the past 12 months. I don't know if that's accurate, but it is often that we meet with clients who are doing their own bookkeeping or prospects who are doing their own bookkeeping, and they have income stated for tax-free categories. These are things like debt, transfers, life insurance, contributions, right? So those things, so let's take debt, for example, because a lot of you might be in the real estate space. Say I get a refinance on a property. I'm in the BRRRR, the buy, rehab, rent, refinance, repeat space. And I buy something under value, rehab it, rent it out, and then I refinance. So say I buy it for $300,000, put a little improvement in, and now it's worth $500,000 according to the bank. They give me an extra $200,000 that I can now go and reinvest into other real estate properties or reinvest into my own health and wellness or give to charity, whatever it is you do with it. But that money, that refinance money, because of debt, comes to you tax-free. Same thing if I took out a loan on a home. I don't pay taxes on the amount of cash that I'm getting from the bank. But what happens is that people who are in the buy, rehab, rent, refinance space, the BRRRR space, if you're familiar with it, they will get that refinance and then they'll categorize it as income on their QuickBooks because they don't know what they're doing. They're trying to do it all on their own. And now they have $200,000 of income that if I'm just preparing their taxes and I see, $200,000 of income, they must have sold a property or flipped a property or something. I might not ask because I'm overworked and have way too many clients. And so now they're paying taxes on $200,000. Say that's the 24% tax bracket. For round numbers, we'll say 25%. That's $50,000 worth of taxes that you would pay that you don't need to pay, right? So you miscategorize the type of income you have and you overpay on taxes as a result. This is a problem with refinancing. This is a problem with life insurance proceeds. Same thing. We had a client who was using life insurance as leverage vehicle, right? Cash value life insurance, whole life policies, index universal life policies, variable universal life policies. These things are tax assets only if you categorize them properly. So if I take money from my life insurance policy to then invest in a real estate asset, I say $50,000. I take $50,000 out of my cash value life insurance and I go and plant it into a real estate. It goes through my business bank account and goes through QuickBooks. If I don't categorize that properly and I'm just not aware of what I'm doing and that QuickBooks tells me, hey, I think this is income because it came from Allianz Life Insurance Company. Should we categorize it as income? And you say, yeah, that's income. Well, now you're paying taxes on that $50,000 that's supposedly tax-free, right? You were offered this life insurance policy because there's so many tax benefits, but if you don't know that it has to be categorized properly, you're going to end up paying taxes on it. We had a client that this was the case for. They were using cash value life insurance, doing their own books, and turns out that they were taking money, I think it was probably in the $12,000 range, and running it through their business bank account. They didn't know how to categorize it, so they would just put it in the income. And then it was in the conversations with them that I made sure to say, hey, let's not count that as income because it's not taxable. And so there's many mistakes that can come, but it starts by not categorizing it properly. Another mistake is not working with a CPA who knows that something like a refinance or life insurance proceeds are tax-free income. Same thing happens when you contribute money to your business bank account. If I take $50,000 from my personal and I contribute it to my business, I better make sure that I'm categorizing that properly and not paying taxes on that $50,000, right? If you're not categorizing things properly, you're going to be overpaying on taxes, and that is not what we want. So mistakes to avoid when doing your own bookkeeping. 1, bad setup. 2, bank reconciliation, not doing them, right? You want to be doing them. Number 3 is tax-free income being miscategorized. And number 4 is missed expenses or expenses that aren't write-offs. I recently did a response video to Bradley, and he was out to lunch with some other influencer guy talking about how he has watches and writes off his watches, and he's just an influencer and he bought it for business purposes so he can write it off. And the fact is that that's not the case, right? So people, and I see this a lot, and it tends to be people that don't enroll in our year-round services. They give us bank accounts as their bookkeeping, and our team's going through the bank accounts and they see, oh, Nike and TJ Maxx and Foot Locker and all these crazy expenses that aren't actually tax deductions. And so what happens is that they take these as tax deductions. The money goes out of their business bank account, and then we actually have to add them back, and then they have to pay taxes on the money that they've already spent. And so it just leads to a greater cost, a greater problem, greater headaches down the line. And the best way to avoid them is to not do it. Missed deductions too is missed expenses, not claiming the expenses that can be used as write-offs. Gym memberships is a great possibility. We have strategies that we can use where, as the business owner, you could possibly write off your gym membership, and it comes with specific stipulations that you want to make sure you're checking all the boxes. So don't just listen to this and start writing off your gym membership. You have to get it qualified with a CPA and tax professional, because there are certain things that the IRS will look for, but it is possible. When you consider your taxes, you want to make sure that these 4 things are being considered in your tax plan. You want to make sure that these 4 things are being talked about with your advisor on a regular basis. You don't want to be making these decisions on your own. I've seen people that have leveraged money properly, but they've recorded it improperly. And if it weren't for the way that we reviewed their books and saw what was going on, they would have paid taxes on that money. And it would have been a mess, and they would have overpaid, and they would have had no idea because they just assumed that everything was happy-go-lucky. So don't be one of those people. These are the 4 things, but you also need to be in the right team to make use out of this information and to advise on what the best thing is for you, how you save money depending on what your goals are and where you want to go, how you invest money depending on what your goals are and where you want to go, how you make money depending on where your goals are and where you want to go. It all plays into it, and you have to have a relationship with somebody who's going to help you see it to the end. So I hope this was helpful. I trust you guys got value out of it. Looking forward to hearing some of your points and reflections. If you did get value, again, leave us a 5-star rating and review. If there's anything that you guys want to hear about, join our Facebook group and start to comment and ask questions and consider what it is that you need answered, and you might just find that we have an episode for you. So until next time, God bless you and keep moving forward.